Thank you, Jay. Thank you, everybody who came. Scott, I run Optiver's Austin office. Optiver is a trading firm, so we trade pretty much anything you think of: stocks, bonds, futures, commodities, 24 hours a day, 7 days a week. And we're very excited to support Austin Forum here. I've been in Austin for about a year and a half. We came with about 15, 20 of us. We are now 50 people and growing quite rapidly. So today we'll talk about financial markets, and we hope this will be a unique presentation for you guys. I imagine most of the people think of markets, they don't always think about the cutting edge of technology, and that's quite a misunderstanding. So in the media and culture today, markets are often associated with speculation, gambling, greed, sometimes scandals. But in reality, like markets, financial markets are just a problem or a solution to solve a problem. And as a rule, technologically, yeah, so too have we seen financial markets riding the same trends, and in some cases lead them. So to start, I'll do a couple of introductions for myself and Luke, chat about markets in general, why they exist, how they function, their importance. Then Luke will take the mic and walk us through the technology side. There you go. So as mentioned, I'm Scott. I'm a trader. My background is that of a trader. That pretty much explains all you need to know about me. Luke, he's our head of, there we go. He's our head of global research infrastructure. He's been 20 years in the technology industry. He's been a longtime member of this forum, so he's probably a familiar face for many of you guys. He's recently joined Optiver about a year ago. So, yeah. Great. All right, so I'm going to start pretty high level, then it's going to get a bit more complicated, and Luke will going to go and dive in a bit deeper on the technology side. So if I start out pretty basic, that's intentional. So what is a market? That was the first question Jay asked. Well, a market is just a place where you can buy and sell something. The grocery store maybe doesn't qualify because you can't just go there and sell your own fruit. But when you think of a market, you think of like a bazaar, a pawn shop, a fish market, stock market. And so why is this important? Well, if you rewind maybe like a few thousand years ago, or maybe further than that, birthplace of civilization. Well, central to every civilization that's ever come up is a division of labor. So before, everyone was both like nomad, a farmer, a hunter, a carpenter, raising children. As people settled into communities, could divide up the work a bit easier. And as they got bigger, city-states, civilizations, the division of labor expanded dramatically. So if you can specialize, you can focus on what you're good at, and you can fill your other needs by way of exchange. So everyone needed to exchange goods, services, etc. A common form of exchange, currency, a place to transact, became market, became fundamental of every civilization pretty much on the planet since the beginning of time. So I know it sounds a bit grandiose, but I think if you look at any kingdom, any type of civilization, democratic, non-democratic, at the heart of every one of them has been an ability for people to divide their labor up and then eventually transact. Currency, that second place for the market. Now, financial market, well, it's just a market where everything is exchanged. Everything exchanged is highly standardized. And so the way, as an example, take a gold ring and take it to a pawn shop, sell it, but you can't go to like the COMEX or the London Metals Exchange, sell gold. You have to sell it like 100 troy ounces increments to be able to deposit this specific spot. So the important thing is understanding the financial market is kind of like any other market, except everything is standardized. Now, I'm going to rewind a little bit here. So on the right, you have a picture of Trajan's market back in ancient Rome. Back then, you could go and like transact in something like 1,000 bushel quantities of wheat before delivery, all standardized. the left, I have the Amsterdam Stock Exchange, where in 1601 you buy and sell shares of the Dutch India Company. It's probably the first stock market. At these markets, yeah, sorry. So one thing I wanted to mention to you guys first, I'm using a little bit different slides than prepared, but I'm all good, Jay. So when you think of capital markets, you think of like a stock market, a place for people to raise money to essentially raise money to do business. Or you think of a bank, you have your deposits, capital available, it's lent to those who need it. It's all about distributing capital to where it's needed. Capital. Now, a derivative market, which you might hear in the news a lot, you hear about options, futures. A derivative market is all about distributing risk from those who have it to those who can handle it. So it's a similar concept to capital markets, but it's about risk. Now, derivative markets are much bigger. They trade significantly more volumes, and so they've become a lot more important for generally businesses manage and reduce risk. Now, at these markets, you're going to have people who want to buy, people who want to sell, and people who are essentially traders, like myself. If you look at the picture on the bottom, you have a picture of the it's a picture from the early 90s of the New York Mercantile Exchange, the oil futures pit. Now, let's say you went on Robinhood or TD Ameritrade or whatever type of platform you use to transact shares or something. The odds that, let's say you want to go and buy Apple stock, buy a couple shares for trading like $270. Now, the odds that when you log in, you want to go and buy this, some other person sitting at home somewhere wants to do the exact opposite thing as you, at the exact same price, the exact same second as you want to do it, is pretty rare. So there are firms that are always out there trading prices for you to trade against. So when you go on TD Ameritrade or wherever and you buy a share of Apple, pretty much 70% of the time you're trading against a market maker. A firm that buys and sells is called a market maker because a market is the place you can buy and sell. So Optiver and firms like us, we're considered market makers. So the odds that you actually are going to be able to go and buy and be able to buy against a random customer, a random other person who wants to sell, is so rare that there's always people like us going to buy and sell, and at all times of the day. So when you see a picture of a trading pit, like you do on the bottom there, a lot of the members in jackets are just different market makers who are there to go and transact pretty much anything that's. So why does this matter? Well, I mentioned a few times that like markets are pretty fundamental, civilization, very important in all types of societies. Where markets are shut down, they get brought back up in opaque markets or black markets, as they're called. So there's a fundamental need for us to exchange things for currency or buy stuff or exchange them. Mostly exchange for currency and buy things. So I'd like to walk you through a few examples of what could happen.
Hey, Scott,
Yes,
we have some requests online for you to hold the mic just a little bit closer so we can get a little bit more volume.
gladly. Better?
Thanks. That's good.
Yes. So I wanted to walk you through a few examples of what would happen if markets didn't function correctly, if they didn't exist. So first, if like one thing we trade is something called interest rate futures. It's a contract you can trade to protect you or reduce your losses if interest rates move or inflation changes. Now, if these didn't exist, well, I think most banks would probably be bankrupt based on all the 30-year mortgages they issued the last 3 years. You probably wouldn't be able to get a mortgage if these didn't exist because it would just be too much interest rate for an institution to handle. So let's say, another example, let's say there's no options market. So if the market, the economy, let's say, slows down and the stock market collapses, well, most pension funds would then stop making their payments. It might halt them for a year, halt them for 2 years, but because they can buy insurance against that by buying a put option or trading a financial product, they can protect their cash flows and protect themselves from that. If we didn't have an oil futures market, think price of oil goes up, your flights are probably all gonna get canceled, and you're probably not gonna get your tickets back. The weather's bad one year, and the corn crop yields are weak, and corn's more expensive. Corn feed's gonna be very expensive for a meat producer. Meat prices are gonna go up a lot. As a matter of fact, many of those meat producers might go bankrupt because they've already guaranteed delivery. So in the end, when I talk about the importance of transferring risk from those who have it to those who can manage it, it actually is quite important because I think it's very, in modern world we live in now, it's very rare that you find the random occurrences of life and nature and these things to disrupt us so greatly. So the world is a very volatile place, and market makers and markets help stabilize and reduce these risks when functioning well. Keep that in mind. So I'm going to start pivoting a little bit more to Luke, but to give you an idea, I want to talk about history of financial markets. We're pretty much moving from the left to the right. So everyone used to trade outdoors. That's the American Stock Exchange back in the early 1900s. In the 90s, it was in these large pits with a bit of electronic assistance. On the top one, you have the London Metals Exchange, where most of the world's nickel and aluminum still trade. As a matter of fact, it's a bit of like it's a bit old school still there. It's still a couch, looks a lot like that. And that's where most of the world's major metals are trading. And now it's all being done pretty much in data centers. So if New York used to be the capital of finance and trading, most of the world's trading happens in Aurora, Illinois, and Secaucus, New Jersey. I don't recommend you visit. So now to move forward, I'll pass it to Luke, who's going to dive more into how we as a trading firm utilize technology to make markets and trade.
All right, thank you, Scott. All right. The volume okay on the Zoom? All right. So yeah, my name is Luke Wilson. I'm the head of global research infrastructure at Optiver. Fairly new, been there about a year, but have a nearly 20-year career in the technology space. PhD in computer science for our computer science grads out there. This is what you can look forward to. And I'm going to talk a little bit about the technology we use in order to build these markets and perform these transactions. Because while running a market in a human scenario where all of the humans are, where all the traders are humans, is very simple. You're doing a handful of transactions per minute. There's not a lot of volume that goes on there because you have to wait for people to write orders. You have to pass the piece of paper around. It's a very slow way of doing things. It was a great way to get, to run these markets, 100 years ago, but the number of people involved in modern markets, number of end users, paper buyers, paper sellers that want to be on the end of the transaction has increased dramatically. And so the only way to do that is with technology. And so now, instead of having a human being make that match between a buyer and a seller, you have computers that make these matches between electronic buyers and electronic sellers, all through the communication of messages on networks coming in from all over the world. And so the rate of transactions has increased 100,000 million fold. And now we have to figure out how to live in this landscape where we're doing hundreds of thousands or millions of transactions per day on any particular product. And so the interaction with today's markets is a lot more sophisticated than it was in the past. So I'm going to talk about three major themes that we see in the way that technology is driving financial systems forward, and the way that financial players, market makers like Optiver, are pushing the technology landscape forward in time. And so the first thing I'm going to talk about is the big trouble with little data. Everyone talks about big data. Everyone loves talking about big data and how we use machine learning, we use all these indexing techniques and whatever to deal with big data. But the real problem is little data. And I'm going to talk about why. And the next thing I'm going to talk about is AI, because I can't come to an awesome forum and be on stage talking without talking about artificial intelligence. So I'm going to talk about what we do with all of that little data and how we use data-driven and model-driven systems in order to make the decisions that eventually go into deciding whether or not we're going to make a trade on a particular market. Now I want to talk about the need for speed, because having the best strategy is worthless if you can't do it in time. You know, if you can't figure out how to compile all the information in time and get that order out to market, it means nothing because someone else has already beat you to it. So I'm going to talk a little bit about how we turn model-driven and data-driven advances and strategies into real transactional performance when it comes time to interact with the market. Okay, so we'll start with little data. So when I say little, I mean very little. So sorry I can't take a poll on Zoom, but who knows how networks work? Raise your hand. All right. So for those that are a little confused, a network, I'm talking here about a computer network, is a way for multiple systems to talk to one another. They do this with electronic signals sent usually by photonics over fiber optic cables. And it's done in bits, but those bits are organized into specific sequences of zeros and ones that are at the lowest level, typically Ethernet frames. So here's a picture from Wikipedia of the structure of an Ethernet frame. It's broken down into octets of bits, and anyone who has a little bit of computer science background knows that an octet of bits is a byte. It's 8 bits. And so this is what we're interacting, Ethernet frames. And they're really, really small. The biggest Ethernet frame that you can send and still be considered Ethernet is about 1,500 bytes, so 1.5 kilobytes. It's really small by modern standards. You know, we take a picture on our phone, we don't think anything of it, but that picture is probably 6 megabytes. It's orders of magnitude larger than this. And so it's really, really small. It's very tiny pieces of data. The problem is we have lots of them. So typically for those of us in the market making business, we're talking to many different markets at the same time. We're looking at all of the different traffic that's passed around. In order to be, you know, an open market, a market has to be able to transmit information about all of the orders that are placed, all of the transactions that occur. And so we get all of this information from the market on the order of billions and billions of Ethernet frames every single day. And so just wanted to make kind of roundabout Carl Sagan reference here, because the number of packets we collect on any given day, the number of Ethernet frames we collect on any given day in the United States, I'm just using Optiver as an example, just for the products we care about, is about 500 billion. 500 billion Ethernet frames per day. That's more Ethernet frames than there are stars in the Milky Way galaxy. And if you look globally at what Optiver collects on all of the markets of interest worldwide, it's about 1 trillion Ethernet frames per day, which is more stars than there are in the Andromeda galaxy, which is the largest galaxy in our region of space. So it's an enormous number of tiny little problems. And so what happens is when you multiply that all together, because unfortunately, lots of little things turn into really big problems, you have 1.5 kilobyte frames that turns into about 1.5 petabytes of data per day that we have to collect. We have to interpret, we have to figure out how to respond to it, and we have to store it. And so this turns into an interesting networking and data storage problem, where we're trying to read all of this information every day, put it on disk, and then use that information at a later time to do something useful. Okay. So, maybe 1.5 petabytes doesn't seem like a lot. So I'm going to convert this into a velocity problem. So if you think about it, and I decided to use a picture of McKinney Falls here just because it's our local Austin waterfall. What does this mean in practice? This means that just for the products that Optiver cares about, and that's not even all of the products exchanged on all of the markets of the world. It means storing 18 million bytes a second. So it's 18 megabytes every second of the day. We're spreading that out all over the world. And that's 24 hours a day, 7 days a week. So as we continue to, as more markets grow, as more players come to the markets, this gets bigger and bigger and bigger. And so it becomes a much more interesting problem to continue to store all of this, to continue to sort through it, index it, name it. Okay. Lots of little data is great. But what do we do with it? And so the next section of my talk here is that you didn't think we wouldn't talk about AI, did you? Because we have to do something with all that data. And data-driven algorithms are really the way we go about turning all of this data into something useful, which in the case of Optiver is a strategy or a derived data type price or a set of volume information that we can use to determine whether or not we want to make an exchange. And so whenever I talk about machine learning or AI, I always use a pretty standard example. Anyone who's ever heard one of my talks has heard the dog-cat sandwich example. And that's where we're trying to get a machine learning system, a machine system to identify, before I talk about that, I'm going to talk about a couple of things. So when we work on processing all this data, we work on using lots of different techniques. Simplest one is regression. Most people know what regression is. The simplest version is you take two data points, you draw a line between them, and you use that to extrapolate into the future. Which with two data points is always great because everything keeps going up. It's not always that way in reality, but that's the way it works with two data points. We also use more complex systems like decision trees or neural networks in order to make better sense of more sophisticated data. We also look at, in addition to all of these supervised learning techniques, unsupervised techniques like clustering or even reinforcement learning techniques. And so we're looking through the entire corpus of algorithmic learning systems to try and figure out the best way to determine whether or not we want to interact with the market at any given moment. Do we want to put in an order to purchase something or to sell something? Is now the right time? And we use all of these machine learning techniques to make that possible. Okay. So if you've ever seen me give a presentation on AI, you've seen an example similar to this. And so typically when I talk about machine learning, artificial intelligence, I'm talking about this cat-dog sandwich example. Can we build a computer system to identify a dog or a cat or a sandwich? So I've limited it to two here. So it's just a dog and a cat. Mainly because I can't find a great picture of a sandwich. And typically what you want to do with most of these machine learning algorithms is just make a classification. You want to be able to look at a picture of a dog and see a dog and respond with dog. You want to see a picture of a cat, respond with cat. That's great. If I were building a camera app for my phone and I wanted to identify all of the little bits in a picture, that would be great. But as a market maker, that's not what we want to do. We want to be able to respond with something that corresponds to what we're seeing. We want to make a decision to sell if we see the right signal in the market, or the decision to buy if we see the right signal in the market. So we want to match what we see to what we want to do. So in this case, we're going to get rid of the labels dog and cat. We're going to match a dog to a dog treat. We're going to match a cat to a cat toy. We want to make sure that we match these things together so that we can make a transaction. And so this is really, fundamentally what we want to do. There's nothing more sophisticated than this. And so anytime someone tells you that there's nothing more sophisticated than this, that means that everything is more sophisticated than this. All right, so the great thing about the finance industry and being able to do all these, build all these data-driven models, we have a lot of data. I just talked about how many Ethernet frames we collect in a given day. And so if we were to take all of these Ethernet frames every single day and then look at 3 months worth of them for training a machine learning model, that would be 60 trillion data points that we can use to generate a model in order to make a decision as to whether or not we're going to buy a product or sell a product. And so there's an enormous amount of, space to play here where, if you're a data scientist or something like that, there's all sorts of data to sort through. There's all sorts of different techniques you can try. There's a lot of space to really be creative and explore all sorts of different options. And just a point, so the 60 trillion data points, just, for the sake of making the same comparison to stars, 60 trillion stars is more stars than there are in the entire local group. That's our region of space. That includes the Milky Way and Andromeda and all of the other galaxies that are nearby us. So for scale, basically everything you can see, all of the stars you can see in the sky with the naked eye are dwarfed by the amount of data we're looking at here. And this is why we have to do a lot of compute work. It takes an enormous amount of compute power to process all of this data, to generate these various models, and to eventually come up with a pricing model or a trading strategy that we're going to deploy out into the market, that we're going to allow to interact with the market, that'll eventually, hopefully, provide liquidity for end users, for end customers. It'll allow you to buy that 1 or 2 shares of Apple stock, or sell those 1 or 2 shares of Apple stock if you want to sell, because that's not possible without, the market maker in the middle, right? If there's no liquidity, if you're waiting for someone, if I were waiting for someone in this room to just show up and want to sell 2 shares of Apple stock to me, I'd probably be waiting until I died. But you can find someone willing to perform that transaction all day long on modern markets because there's a market maker, a set of market makers behind the scenes that are willing to make that possible. And they make that possible completely through technology. It's all done algorithm. And so the same types of compute infrastructure you would use to do these really big fancy things you hear about in the news, you hear about from science magazines, stuff like that. Same types of compute horsepower you use to generate these large climate simulations, or to simulate the merger of black holes, or even to do things like model spike protein into the SARS-CoV-2 virus. The same type of technology is then brought to bear on the financial markets problem every single day. And every single day it changes. So it's not one of those things where, like a dog-cat sandwich model, where we can train it and then we can walk away, because a dog is always going to be a dog and a cat is always going to be a cat. The market changes every day. And so we have to retrain our models every day. So every single day we're going through the process of using all of this compute infrastructure to generate new models that we can put to bear on the market the next. All right, that's great. I can build a fancy model. Cool. What good is it if I can't use it? And so the next thing I want to talk about is speed. And in this case, I'm talking about speed in 2 senses. First, we need to be able to very rapidly use all of these seemingly disjoint Ethernet frames to reconstruct the state of the market. We need to know what the price of something is at any given moment. We need to know who the buyers are, who the sellers are, which is basically something called reconstructing the order book, the set of people who want to buy, the set of people who want to sell, and what price they're willing to do that. The other thing we need to do is very quickly put in our own orders. We need to participate. So we both have to very rapidly decide what the market looks like, and then decide if that's a market we want to be. And so, I'm going to go through a couple of examples of how big this problem is, and the techniques we use to try and get to the end state. All right, so how fast are we talking about? So I'm going to compare this to a bolt of lightning. So the time it takes lightning to strike the ground from the cloud is about 30 microseconds. It's pretty quick. Doesn't take very long. It's not like you're going to outrun a bolt of lightning if it's going to strike you. So it's very, very quick. But when we make a trading decision, that trading decision has to be made in about 300 nanoseconds. So that means that we have to make the decision 100x less time than it takes for lightning to strike the ground. It's very, very fast. And this is a number I'm willing to give you so you know it's not correct. But yeah, about 100 times faster than a bolt of lightning. And so to do that, we have to be willing to put up first with some, dealing with things we wouldn't normally want to deal with. So if we have our dog cat model and we want to be able to match appropriately, we want to say, okay, well, if I see a dog, I'm going to provide a dog toy. If I see a cat, I'm going to provide, or a dog treat. And if I see a cat, I'm going to provide a cat toy. That's great, but I have to do this in under 300 nanoseconds. So I probably don't get to see the entire picture of a dog or the entire picture of a cat. What ends up happening is I see a little bit of it. Maybe I see that much of it, and I have to make a decision. Okay, am I going to respond with the dog treat or am I going to respond with the cat? All right, so poll of everyone in the room. If you would, so if you saw just that much of either one of those pictures, who would respond with the dog treat? Who would respond with the cat toy? It's hard because it looks exactly the same. And sometimes that's what happens. Everything looks exactly the same because we see basically the front end of an Ethernet frame. But sometimes there's a very small distinction, 1 or 2 bits, and we'll make a decision from that. But for the normal human being, it'd be difficult to make a decision. We have to do that on a daily basis. Every single transaction we have to make this determination as to whether or not we think responding with the cat toy or the dog treat is the right choice. And so how do we do this? How do we build systems that respond so quickly? Well, in the modern world, for all the recent computer science grads out there and everything, the first response is typically, oh, well, I can write a program to this. I can respond to software. Computers are fast. I can write really fast software. Okay, let's say you can write really fast software. The fastest software you're probably going to be able to write will probably respond in about 100 microseconds. Fast, very, very fast, but not fast enough. Still need to get down to 300 nanoseconds. So software is no good. We got to throw it out. Okay. Let's say I could build the fastest software in the world and I can run it on a computer. Great. Is a computer fast enough to actually do this? Well, unfortunately, it's not. So if you think about it, we see a signal when it comes in through a packet on the network port. And in order for us to interpret that, we have to bring the data in from the network port into the memory, load the memory into the CPU, make a decision, send it back to memory, and then send a response out through the network port. Well, the fastest you could possibly do that is about 10 microseconds. It's just not fast enough. You can't build a system on a standard PC and get it to respond quickly enough to do what we want it to do. It just won't work. So what do? We stick to the NIC. We don't want to have to leave the network card, go out to memory, then to the CPU, and then to memory, and then back out to the network card, because it takes too long. So we do everything in the network card. Now, this is a standard network card you would put in your desktop PC. There's unfortunately nothing you can do with this network card that would allow you to do anything interesting. You can't put any programmable logic on it. You can't do anything that allows you to decide to throw a strategy or a trading model on there and get it to respond in time. Thankfully, they make more sophisticated network cards. So they make network cards like this that have things like field programmable gate array systems on. And this is a set of programmable hardware logic where we can actually program into the system what we want it to do. If we see this type of activity on the market, we want to make this type of response. And we can do that over and over and over again on this programmable logic. And then what we do is, as the market changes and the way we interact with the market changes, we can change the way that our hardware responds by changing the reprogrammable hardware. And so this is really the only way being able to just come in on the network port, have the FPGA respond without ever going outside the card, is the only way we can actually make the response time we need in order to be successful. And there's a lot more that goes on here. So there's a lot of other things that go on the baseboard computer and updates that happen, things like that, that I'm not going to tell you about, but in its simplest form, this is what we're doing. So there's all sorts of technology that goes into this, from building machine learning models to doing network optimization, storage optimizations, storage indexing, reprogrammable hardware for those of you in the computer engineering space. All of this has to go into making any successful trade-off model. And it's only getting worse. So there's more than just one market maker out there. We're all competing to do the absolute best we can to be the first to provide a response to a particular event. And so we continue to push the state of the art in all of these spaces, trying to maximize the amount of data we can store in a certain amount of time, minimize the amount of latency between a switch and a NIC, minimize the response time between the first photon in on the NIC and the first photon out on the NIC. And so it's pushing technology forward at the same time it's making it more accessible. And so just to wrap up, like Scott said, these markets have evolved over millennia. It started as very simple, typically agricultural transaction systems, slowly evolved into more complex things like stocks, and then derivative systems like futures and options. And now we've eliminated most of the humans in the process. It will be almost in everything by a machine. And so this injection of technology into the financial markets is accelerating the evolution of this. We now trade more products than ever before. There are more ways to manage and divest risk for most people. More ways to provide stability in the financial markets thanks to this acceleration. And in the reverse, all of us who compete in financial markets are pushing technology forward because we demand the reduction in time to solution for all sorts of different products. And the amount of data that we're processing continues to grow. And so we push the hardware and the technology space forward, trying to be the best, and trying to be the first in the market from the line. Okay, so wrapping up, if you have any, if you're still interested in this, and I hope everybody is, we got a blog post that you can read. It's in that QR code on the left, and then the QR code on the right is actually a YouTube series put together by one of our traders in Amsterdam. It talks about how options markets work in extreme detail. So if you want to learn exactly what the mathematics is behind deciding whether or not to make an options transaction, what an option is, what the pieces of an options contract look like, you can take a look at that QR code on the right. It's a 9-part YouTube series. It's a great little primer into the options market, and gives you a sense of what we do at these market makers. And with that, I'll turn it back over to Jay. Thank you
Give
very
Luke
much.
and Scott a round of applause before we start Q&A. All right. So as a reminder, if you've got questions, submit them to the event questions channel on the Austin Forum Slack space. I'm actually going to ask you guys a couple of questions to start here, because this was actually new to me, even though I've known Luke for 20 some years. He's been working at Optiver a short time, and I haven't had a chance to even catch up with him. So if I understand it correctly, and Scott said at the beginning, every time we go and make a trade on our own, the trade is being resolved probably by a market maker. There's not some other individual like, James out here in the audience isn't seeing me post something for sale and him buying it. Market makers are buying those, making the buys and the sells, right? Correct. And then I know your cat dog example was probably meant to be buy, not buy, or sell, not sell. So you've got to look at tiny amounts of data and then make a nearly instantaneous buy, don't buy decision, or sell, don't sell decision. Correct.
It's more complicated than that too, because sometimes it's more like we want to change our price, provide a better price, or maybe, if new information occurred, something changed in the market, we want to change the price we want to show. So even in the absence of you looking to go and, let's say, transact, we're always streaming prices, and these need to be up to date. So if, something happens in Tesla stock, that might change what prices we're willing to buy something related, or if a war erupts, it's more extreme. So it's not just whether we want to buy or sell, but at every point in time, we are always having a price we want to buy. And so if it's not up to date, we would just expect to lose money on it. So we're always trying to do the best. And we're competing with maybe 10, 20 other firms as well. So we're all competing to show the best price for you to transact against.
So when someone executes that sell, all these market makers are seeing it as fast as they can. And then one of them is beating the others to the punch on making that buy.
It depends. So if I have an order out there saying I'm willing to buy for $1, and you, Jay, say, I want to sell for $1, that order will get matched based on who was the first to show that price. So that might be, now in another situation, let's say you said, I'm willing to sell for $1.01. And let's say no one else wants to buy it, but you're kind of an order that's sitting there. This is called a good per day order or good till cancel. And then let's say something happens that makes it so that firms want to buy it. Now, all these other firms are going to race to go buy it from you. So it's I guess one way I said we're more passive, or I'm sitting with a bid and you chose to transact against us. Sometimes you show a price you want to transact and you're waiting for someone like a market maker to say, no, I'll transact with Jay.
Got it. So you see all these opportunities, or I should say your compute infrastructure sees all these opportunities to buy or sell. It has to make instantaneous decisions. So humans obviously program the algorithm into the infrastructure, but in the course of an hour, a vast number of trades are being made by your automated software. So how often does a human step into the loop and say, wow, our algorithm's not doing very well with these new market conditions caused by a war in Eastern Europe?
I would say for the examples we're talking about, which some things pretty straightforward, like a stock or a futures contract, we don't really we monitor and we provide guardrails as a human. So we more step in it so that it doesn't look like it's performing correctly. But ideally, we're just not stepping in. But it's just, it's a risky business. So you always want to make sure that, like, for example, if we know today, we knew Jay Powell was giving a testimony to Congress, and he was going to release the transcript of his speech ahead of time. Okay, then we do interfere and make sure that, let's say, make some adjustments, waiting for that exact time the transcript is released. So a little bit of interaction there, but most of the time, it's no interaction.
So if you're developing this infrastructure, software and hardware, to monitor these markets and make nearly instantaneous buy and sell decisions, how do you evaluate how good your software is compared to the other 20 market makers out there? I mean, you can't do A/B testing, right? You don't have one algorithm running for half your trades and another one running for the other, do you? I mean, how do you improve it? How do you determine that there's room for improvement?
Well, one of the nice things is that if you do badly, you lose money. So in many ways, the market does teach you in that regard. However, let's say you have two different ways you want to trade. Well, one, you can run it through backtesting on historical data. That can give you some insight. It's not perfect because your behavior might change what you're looking to. So yeah, actually pretty much every trading firm does engage in a little bit of A/B testing. Yeah.
Now I'm going to bring to the stage our managing director, Allison Warner, who's going to ask a few of the questions that you submitted tonight, including picking one for somebody in the room that wins a badge to South by 23 or 24, your choice. So please welcome Allison Warner.
Okay, guys, we had some interesting questions, including maybe one job inquisition. Position is the correct word. I'll forward you the information. So first. is our Very own John Lockman. How do you see financial trading pushing technology advancements in hardware and software?
Good question. You don't win a badge.
Sorry, John.
So really it's about, there's two ways that, we see, our use of technology pushing technology. One is in, latency reduction. We need, and that's not just like network latency. Obviously, we want to be able to figure out how we can reduce the amount of time from first photon received to the first photon transmit, basically. Or more importantly, from the first photon received to the last photon. And that involves a lot of optimization. It's not just like SerDes optimization on the network card, serializer, deserializer for everybody who doesn't know. It's just the way that we convert what we're wanting to send into the optical signal that actually gets transmitted over the wire. But also reducing the amount of time it takes to make that calculation in between, where we decide, what price we're going to put in that particular order that we transmit, or what product we're actually going to transmit, because we don't necessarily look at the world holistically and then construct what we want to say and then send it. We're kind of constructing it on the fly, because the time it takes to construct an order, the market is changing because other people are interacting with it. So we can't always wait until the entire order is constructed and then send it out like we're putting a letter in the mail and then mailing it off. So optimizing all of that process is kind of where we look to push the state of the art.
And a similar question, slightly different. What financial technology are we lacking that is needed to fill a gap? And is there an AI advancement that's coming out similar to ChatGPT related to financial markets? That question's changed.
I think, so what's lacking in financial markets with regard to technology? I mean, the most common thing people point out is slow pace of clearing and money transferring. So that's often where the crypto industry gets kind of built out of. I'd say that any ability to run more complex calculations is going to be quicker, is going to be the most important. I mean, if you think about, and so we mentioned small hardware, so it's not just about, the trade quickly, but, can you build a complex model that can run in real time at low latencies? Now, as far as ChatGPT is concerned, there are firms out there who, read news feeds, get Twitter feeds, Bloomberg feeds, and they do conduct trades with basic language models. And they will do automatically transact. The big headline comes out, that's already present. That can only get better, I think, with better language models. I imagine that all the researchers and developers can be a bit more productive with something like GitHub Copilot, ways to just more quickly write code. But in terms of like, neural nets, boosted trees, I mean, these are all prevalent very much in markets already, actually. So a lot of the same models that are being used in ChatGPT have been in markets for years.
Just one second. Okay. How does Optiver store all the data it's gathering every day? And what are some of the hurdles to storing?
Sure. So it's really simple. We store data on hard drives. Now we don't necessarily use spinning disks. We're using technology like SSDs and NVMe, but it's we have different layers that allow us to store things at different rates because it's important that we don't drop it. And we have packets coming in at a very rapid rate. We don't want them to spend a lot of time in the processor, kind of floating around or in memory floating around before they get written to disk. We want to be able to write them to disk right away. That way we don't lose the packets that are coming in behind. So, yeah, it's really about kind of just picking the fastest storage technology we can find at the moment, that makes sense. So that we don't lose any of those network packets.
Jay, how much time do we? Okay. Okay, from Brittany Glassschroeder. Beyond overall increased market efficiency, have high frequency traders seen an increase in profitable trading?
I would say the industry profits have grown over the last few years. That's the short answer, but, overall, the amount of volume transaction on world markets has increased quite a bit. Varying trends drive that. One is just general economic growth, opening of financial markets in India and Asia. There was a big boost during the whole meme stock craze, or the day trading at home craze during the pandemic. But overall, I'd say as an industry, yeah, it's been growing. The profitability industry has been generally growing. It's a growing industry, and it has been really the whole career.
I have a question. Do you get a lot of junk data? And what do you do with that junk data? And how do you determine what it is junk data?
Depends on what you mean by junk. Do we get corrupted data? Sometimes. And we typically solve that by collecting data more than once. You know, we look to collect every packet a few times, and then we can make sure that if one feed gets corrupted, we have copies somewhere else. Or if for some reason someone accidentally bumps a network cable or something up against on a switch, or a switch falls over, we can collect it from other places. And so that's kind of how we get around the junk data. Junk data is corrupted data. Now, in terms of like malicious injection of data into a market stream, it does happen. And it usually happens by someone who's inside the market system. And so there's a lot of regulations around it, a lot of rules around what kind of data packets you're allowed to send to an exchange. And that is not only policed by the exchange themselves, but policed by other market makers like Optiver. So if we notice things like that on a large scale, we will let the market know. Like, oh, okay, hey regulators, we see something going on here. Maybe you should go investigate. But outside of that, like a completely external malicious attack, those are pretty rare. Because these are very closed systems. They don't really connect to the internet in the standard way. Like you would normally think, these are very closed ecosystems with direct attached cables. In most cases, regulated lengths of cables, so that every market maker who's interacting with the market has the exact same travel time for the light from what they're to the exchange. And so no one has an advantage over anyone else because their photons had to travel 12 nanometers less than someone else's.
And the last question, if the person is in the room, is from Michael. There you go. All right, cool. What are some ways technology innovation can open the best investments to disadvantaged populations to help close the gap?
One example I use a lot with new hires is, if any of you guys ever been to like a airport exchange, like you go to like for the airport, there's a currency exchange desk, and people are kind of standing in line swapping the dollars for euros. Like every time they do that, they're losing about 9% of their money. That's how bad the prices are being displayed there. Whereas if I go into my interactive brokers, I can do that and lose 0.01% of my money in net transaction. I use that example to illustrate, like, if you live in a world where the transactions you make, whether it's to buy something, borrow money, send money, these things. If you live in that airport currency exchange world, it's a very different world than if you live in the world where you have like very good access to financial markets like I have. Yeah, it really just saddens me when I see that. And if you know, so when I see like let's say I visit, for example, Peru a lot, and where you have a lot of transactions are in dollar denominations. People who are on the sidewalk who will be want to transfer Peruvian soles for dollars. And yeah, I think it's the effect of that world is quite, it's quite costly. Just imagine like having this Western Union exists, and Western Union is actually pretty efficient compared to like a lot of other ways of sending money across the world. So I think when you have such a setup, you have what's called I think it's called dead capital, where if you have a home, you can't leverage it for a mortgage, you can't start a business, you can't open a bank account. So when I think about how financial markets can help broaden the world, like it's a very different experience people have. So one of the most obvious things I think is like access to banking. Like I don't think every like impoverished populations across the world, it's not like they're missing out because they can't buy an index fund, but in fact, like the ability to actually securely bank money, be able to have transactions that are relatively efficiently. I mean, it's right now for us, it's like I think it costs probably 1% to do an ACH transfer, or something like that. Like it's actually like it's much worse for like people rest of the world. So I mentioned that point earlier where like the ability to have a common means of exchange, the currency, is something not to be taken for granted because a lot of population doesn't really have that the ways that we're used to it. I think a little bit less about like financial and derivative markets, and I think more about those actual core basics of like a good banking system where you don't store your money in your pouch, where if you need to have an asset and mortgage it, so really pledge your house to borrow the money to whatever means you have. I think of those things mostly when I think about financial markets. What's and yeah, yes, later down the line, raising capital, venture funding, stock markets, I kind of see that a little bit